Welcome back to the IT Investor Podcast, where we help IT professionals stop trading time for money and start building real cash flow. I'm your host, Pramod Gudishetty, joined by my co host, Wally Taylor.
Today, we're answering the question everybody is asking right now. Is 2026 a good time to buy multifamily? And more importantly, how should investors be thinking about this market when there's still so much noise and uncertainty out there?
Yes. Hi, Wally. How are you?
Good, Pramod. How are you?
Yeah, doing good. What if I told you, Wally, that the best multifamily deals are made when everyone else is sitting on the sidelines?
And what if the uncertainty you're seeing in the market right now is actually where the biggest opportunities are being created?
Yeah. So let's see, Wally, what's actually happening in the market these days. If you go back 3 years, and let's be real, interest rates shot up, deals stopped penciling, and a lot of syndicators disappeared, if you remember. So, in a nutshell, 2021 to 2022, we had too many buyers. In 23 and 24, the market froze. Probably in late 2025 and currently 2026, we are in the first quarter, March right now. I'm seeing a lot of selective re-entry into the market and transactions are happening. Now that we are in the early phase, and that's usually where smart money moves first and disciplined deals get done. Big gains are quietly being set up.
Yeah, I completely agree, Pramod. That easy money era from back in like 2022 is completely over. And honestly, I think it's a good thing. Money was cheap, a lot of weak deals got done, and a lot of people confused a strong market with actual operator skill.
Yeah, yes, Wally. And let's look more in detail what's happening now. Capital is coming back, prices are correcting, sellers are being more realistic, meaning better pricing and terms. And only serious operators are still standing in the market. And these operators have the ability to negotiate stronger downside protection. Deals are underwritten conservatively so that there is less hype and more discipline. In hot markets, Wally, if you remember, deals were won with optimism, where everything is green, right? But in uncertain markets, deals are won with math and patience.
Yeah, translation for the listeners, the tourists are gone, the professionals are left. And that matters because this kind of market tends to reward experience, patience, and operators who know how to manage risk when the numbers get tight.
Yes, that's right. Wally, now let's look why most investors are sitting out. I mean, right now, most investors are frozen, right? I mean, they're thinking, what if the prices drop more? And it could be an early entry for them. And they're also thinking at the same time, probably the rates can go even more further down.
Yeah, I feel like in real estate, especially, we're always kind of waiting for prices to drop, rates to go down. But the truth is, the best deals, they're not ever going to feel 100% comfortable. The best opportunities will usually show up when headlines look messy and confidence is low.
Yeah, I completely agree on that, Wally. And if everything feels safe, that means we are too late in the deal.
Yeah, absolutely. So I want to answer where the real opportunity is right now. Where are we actually seeing opportunity? It's not everywhere, and it's definitely not in every deal getting pitched, but there are some very specific pockets of opportunity that smart investors need to pay attention to.
Yeah, Wally, if you ask the question, where are the opportunities today? There are three areas where we can find these opportunities. One is in the distressed deals, which were done during the 2020 and 2021 era. The second is the assumable debt deals. And the third is the strong operators playing offense. Let me go in depth a little bit more. So for the first one, distressed deals, the floating rate loans are resetting, and they're resetting because the debt payments exploded, right? I mean, where the operators were unable to pay the mortgage and they are forced to sell. The second, assumable debt deals, this is where like lower interest rates are already locked in, and there is a massive advantage in today's environment. And lastly, the strong operators playing offense and buying when others can't. You can negotiate better terms and you can structure these deals more conservatively.
And this is key, Pramod. I mean, not all deals are good, but the good ones right now, they are really good. Better basis, better terms, more realistic underwriting, and in some cases, less competition than we've seen in years.
Yes. Well, now let's take an example, a real story from a credible builder, and we'll look at this deal. So this operator had a floating rate debt, and because of the interest rates as they were going up, their payments increased significantly, and unfortunately they simply couldn't hold on to the property. So most people usually run away from that, right?
Yeah, I mean, increased debt payments, decreasing DSCR ratios, like that sounds like a pretty risky situation. So what did you see?
So we saw a discounted purchase price on that property and saw an opportunity to fix the debt structure. Believe me or not, the property was pretty strong with fundamentals. It just needed new debt structure, same deal but with a different lens. And Wally, let me ask you a question. What are smart investors doing now?
I mean, Pramod, smart investors right now are doing three things. We're doubling down on the due diligence. We're going to focus on downside protections. And we're going to make sure we're partnering with experienced sponsors who are spending less time chasing hype and more time making sure deals still work when the conditions are less than ideal. You know, investors are no longer chasing those 20% IRRs anymore. They're starting to ask smarter questions. What happens if the rents don't grow? What's the break even occupancy of a property? You know, and how resilient is a deal? Did we stress test different potential outcomes to see if the deal will still be successful? You know, it's important. That shift in thinking is a big deal because it moves people from being hopeful investors into being disciplined investors.
Yeah, I like it that they are not chasing the numbers where it is 20% IRR. Yeah, I think they are definitely asking the right questions. What is the risk mitigation? And this is a risk management market and not a hype market.
Yeah, I completely agree, Pramod. I would even almost say that 20% IRR is almost, you know, if you see that come across in a pitch deck, that might be a red flag for somebody's underwriting is not too conservative given the current environments. But yeah, there's been a psychology shift in 2026. You know, the mindset of investors has completely changed. A few years ago, people were mostly focused on the upside, and now we're paying more attention to the durability of a deal, debt structure, and how a deal performs when the market stops cooperating.
Yes, that's where the real wealth starts. I mean, where the shift right there is. So, Wally, in today's market, what a deal needs to work in 2026? If you ask me that question, you need to definitely have your break even occupancy of about 70 to 75% at your multifamily property. And your conservative growth can be probably 2 to 3% and not 5 to 6%, and should have a fixed rate debt where it does not get reset aggressively in 2 or 3 years.
Yeah, completely agree, Pramod. Conservative rent growth is a huge one that can kill deals. You know, if you're planning 5 to 6% a year, you know, we've seen it in the last year or so, maybe 2 years, rent growth, especially well, in most markets, pretty stagnant, maybe 1% increases. If you're not underwriting for that, you're kind of setting yourself up for that lack of that that income growth. I mean, then you hit the nail on the head with the debt. You know, more conservative with how you finance these properties. I tend to steer clear of that bridge debt or that floating interest rate debt. I like that fixed mortgage. You can kind of count on payments staying the same. So if a deal still works under these assumptions, that's when it does get interesting. You're not underwriting for a perfect market, right? But you're still underwriting for reality, and that's better for you. Excuse me. You're underwriting for reality, and that's where it gets better for long-term decision making.
Yeah, yeah, yeah. Um, okay, Wally. Now let's see what are the biggest mistakes to avoid in 2026.
Yeah, biggest mistakes to avoid right now is waiting for perfect timing. A lot of people are telling themselves, you know, I got to be cautious when they're really just delaying the work of getting educated and building conviction on multifamily investing.
I agree, Wally. There is no better time because by the time rates drop, headlines turn positive, and everyone feels confident again, and prices will be higher again.
Yeah, you've missed your chance at that point. That's the best time to sell it.
Correct.
Yeah, I would say a deal with a strong operator, somebody who can mitigate risks even if, you know, things aren't perfect. So that's really the framework. No, not hype, not shiny projections, not hoping the market will bail you out. You want a deal led by people who know how to protect the capital, make solid decisions under pressure, and execute when that original plan has to adjust a little bit. That's how smart investors think.
Yes, that's very well put, Wally. So, if you have been waiting for the perfect time to invest, this is the reminder that perfect timing usually shows up after the opportunity is gone.
Yeah, the goal isn't to rush into a deal or force something that doesn't make sense. But the goal should be to learn how to spot the right one, ask better questions, understand what actually makes a strong deal in a market like this.
Yeah. Yeah. And in 2026, the edge doesn't go to the loudest investor. It goes to the one who understands risk, knows what to look for, and is ready when the right opportunity shows up.
Yeah. So if you want to see how we break deals down, what we look for, how we think through risk before capital goes in, send us a message with the word deal. And we're happy to show you the framework behind how we evaluate real opportunities.
And if this episode gave you a better framework for thinking about multifamily in today's market, share it with another IT professional who wants to build wealth without making emotional investment decisions.
Thanks for listening to the IT Investor Podcast. We appreciate you spending part of your day with us and being here as we talk through what it really takes to build wealth through investing.
We'll catch you next episode. Thank you.